Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, traditionally Canadian banks have done rather well, but are they going to continue to be financial stalwarts?
Well, there's something different between the stability or sustainability of the institution and its share price. You know, they're not the same thing. So my point would be that the share prices became quite exuberant and overvalued in the longest credit expansion in the last 100 years, which happened into 2019. And as we've discussed before, Canadians were very quick to take on more credit, both to make ends meet, but also just to lever themselves into very expensive housing. And that drove prices up further, of course, and it became the great chase to try and keep up. And that's left us with a heavy hangover of debt. And now, of course, as we come into the coronavirus recession, which the C.D. Howe Institute has officially declared has commenced in March. Now as we hit this recession, we come into it, unfortunately, the least prepared and most vulnerable of the past several recessions. And Canadian banks in the past last two bear markets in 2000 to 02 and in 2007-09 lost over half their value. The shares themselves, the preferred shares also had a significant drubbing in that period because they tend to be quite illiquid, down by half, lots of them. So it is, it doesn't mean that the institutions themselves won't survive or will go under or anything, but the share price just became too wildly disconnected from the actual end of the credit cycle that we were approaching. So I was writing about this, even in 2018 and 19, how the numbers were going the wrong way in terms of for investors, that they were paying too much multiple for too lofty expectations for this insatiable and never-ending credit cycle, which has never happened, right? Every single cycle ends. There's never been one that continues forever. And this one, despite all of the massive intervention even before the pandemic, of course, the ultra low rates that were left there for years, the injections of asset buying into financial markets, every preferential treatment that was possible was given to financial companies, all under the presumption or the moniker that they would, drive lending and spending through the economy. But in fact, what happens is at some point there's just this level at which consumers can't service more debt and businesses, can't take on more debt. And that's happened in 2020 because of the abrupt stop in income, of course. And also just, the abrupt stop in cash flow reveals how many savings deficits there are both in companies and in households. So the private sector is highly levered coming into the worst depression since the 1930s. And, it's hard to even get your head around the numbers here. So my point would be that, the Canadian financial sector on average is off 30% from the February high, and that's notwithstanding the big rally of the past, from March to May 11th, there was a big rebound, still off 30%. The U.S. financials are off just a bit more, about 33%, and this doesn't bode well because the financial sector tends to lead the overall cycle. Certainly in Canada, it's 34% of our overall TSX benchmark, and when you see, we've had some rebound in gold miners, and in the energy producers, quite honestly, from the all-time low, which has helped support the TSX. But the 34% that's in the financials is its greatest vulnerability. And then the energy patch, of course, is its second largest weight. So I think that there's much to be said that we could see, there's much reason to think we could see another 20% decline perhaps in the share price, and potentially even more. I mean, we didn't even have a recession in the 2000 to 2002 bear market. The U.S. had a mild recession. Canada didn't have a recession. The tech sector bubble was arguably more concentrated in America. Of course, we had the Nortel fiasco here. But basically, even without a recession in that period, the Canadian financials lost 50%, and the overall benchmark in Canada lost half with it. And I think that this time we potentially have more vulnerability there. The stats just it's mind-boggling. We know a third of Canadian households are under government support for income because of all the job losses that have happened so far. We know that we're only not even 2 months into this recession if it started in March, being that it's the middle of May, and that on average recessions last about 12 months. But there's much reason to think that this particular recession is not average in any way, of course. We have already about 13% unemployment. We are, on track to have a 45% contraction in the second quarter. The consensus estimate is for about a negative 9% on GDP for the full year, and that's assuming we get a significant, rebound in the second half of the year, which at this point is hoped by many, but not necessarily in the cards, right? We have to see how this lockdown goes. Certainly the extension into the fall is becoming sort of widely discussed in terms of, many events, large gatherings, schools. There's a lot of talk about things being online even in the fall, and some companies have announced that they're going to let workers stay working from home into the end of the year. So it's very unclear what the second half of this year looks like. But the point is that even assuming it's positive, even assuming it's much better than the first half, you're still having the largest economic contraction of our lifetime. And that is not something that bounces back quickly. So for all these reasons, not just the strains in the oil patch, which are, a major exposure for Canadian banks, they did pay down their lending. They did retract their lending to that sector after the 2015-16 meltdown, but then in the last couple of years, they re-extended the loan exposure in that sector. So that's bad, and the household vulnerability is a weakness for the Canadian banks. And of course, the very low, ultra flat yield curve is very negative for profits. We've seen this in the U.S. banks, but also in the European banks, which have struggled for many years now in this, crazy nil to zero interest rates. And so that, plus they don't have as much capital underwriting, of course, as the American banks. And in bear markets, there isn't a lot of underwriting that goes on. So all these things suggest that loan loss provisions are going to increase. And it's interesting because, Steve Eisman, if you recall, the guy who was featured in the film Big Short, he's been shorting the Canadian financial sector and Canadian banks in particular for the last couple of years, and he had a very controversial position on there where, a lot of the business news stations were asking him, banks are doing great and earnings are great. Why would you be shorting them? And he just kept saying, because I think you're coming to the end of a very extended credit cycle, and I expect that when you come to the end of a credit cycle, banks always do poorly, and earnings come in, loan loss provisions rise, and all that is always unexpected because people only expect the very best, it seems. So all of those reasons suggest that there's quite a bit of vulnerability still in the Canadian banks, and from here, potentially, we're maybe 20% or 30% more to the downside here before this recession, before this repricing of the recession is complete. And that could happen over the next several months. It's very difficult to know how fast it will happen, but when it does complete, they will be, I think, an opportunity to buy, not so much for capital gains, which is what people have been used to thinking of in the past few years, but because dividend yields, to the extent that they don't cut the dividends, once the price has fallen by half, the dividend yield is a lot higher than you could have got before. And that is really the engine of all compound returns over time, is the extent to which you can lock in the higher dividend yield. So I think there's going to be upside, but most people are, unfortunately, many Canadians are very concentrated in this sector coming into this downturn. And, they've been elated by the rebound in the last month, thinking, oh, thank God that's over. And my caution to them would be, it's very likely that it's not over at all, and that you're going to see another retest of the lows and potentially a lower low before this cycle completes.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Danielle Park. Danielle, what's the strategy for minimizing losses in this kind of market and perhaps even making some gains?
Well, there's a couple of ways to do it. Some people do long short strategies where they use short positions that go up when prices fall. When the prices in assets fall, short positions will increase in value. That will offset any long positions they have. That would be more for a net neutral approach to try and, offset any losses. It sounds perhaps, well, why wouldn't everyone do that? It's because it's quite complex and difficult to do and to get the ratios correct. And it can open you up to even more losses should your shorts go against you, more than your longs work for you and that sort of thing, or vice versa. So there is that approach, and some people do that. The other approach is, frankly, to just not participate in the extremely valued assets coming into the end of a cycle, and that's really the approach that we use, because it is the correlations go to 1. Every sector, basically the only things that are up year to date are bonds and gold, bullion. Everything else has fallen. Many of the international markets are even worse than North America because there's been more sort of Fed-induced CNBC cheerleading here to get the bounce in the last month. But overall, most emerging markets are negative, severely negative in the last year. So are European markets. And, the so-called defensive sectors, I always kind of get a kick out of this. You hear most people, their approach, or most of I call them the long always crowd, right? They always want to sell people on the idea of holding and hoping for the best, right, on stocks. And so when they come into the down cycle part, the recession part, or the bear market, they will not recommend people sell and leave stocks or corporate debt, but they will suggest that you shift to what they call defensive. So if you look at that, that would be, things like healthcare and consumer staples and, but the problem is that all of those sectors have lost money year to date. So if you look across, the best performing sector has been technology. The U.S. technology sector ETF, the XLK, is just barely positive year to date, but every other sector is negative. So this is the reality, and so you can't sort of just, I call them different colored jelly beans. You can't just hold different colored jelly beans. They're all jelly beans, and when jelly beans are out of favor, you don't want to be holding them. So it takes a more risk-managed approach, but you can be owning things like the bonds that are appreciating in this environment, sometimes bullion, although that's a complex issue too, because the shares can tend to trade in correlation to the overall market as well at the end part of a cycle when there's liquidation. And then, there's nothing wrong ever with good old cash. Cash and U.S. cash can be a great hedge or place to park, place to stay while everything's selling off, and then to maintain liquidity for when you want to have a buying opportunity, which will come. There's no question. This one's setting up to be better than average. But it isn't, 1 month does not a bear market make. And if you look at this, the activity that we've had year to date, which, the big, almost 40% decline, 37% decline between February and March, followed by a 30% rally. It has the effect of making people think that it's all fine again. And actually, if you study bear markets, you understand that is the typical Fibonacci retracement. That is an absolutely common pattern. It happened in the 1929 bear market, where you had the huge drop and then a huge recovery and then the next big leg down. It happened in the 2000 market recovery. In 2008, we had 3 or 4 episodes of 20% rebounds before you got the next leg lower. So it is not at all counter to how a bear market moves, and it doesn't mean you're into a new bull market. So it's understanding that big picture and what environment you're actually in is critical, so that you don't position yourself for long and wrong and stay with things as they, tank, because once you drop 50%, you need 100% gain in years typically of holding and hoping just to kind of recover your losses. And very few people have that kind of time or tolerance to do that sort of thing. And even, the so-called long-term investors like Warren Buffett has long always said that, the first thing people should worry about is don't lose money. And yet most strategies, most asset allocators have zero strategy to protect people from losing money. It's all just, we just put it in, we move it around, we hold different colors of things, and we hope for the best. And that strategy in a regular recession bear market is very devastating, as people learned in the last 2 down cycles. But I'd submit to you that in a depression like we're in right now, that is likely to be, a horrible approach. And again, most people are in their 50s, 60s, 70s before they get the bulk of their net worth. And they simply don't have the time to spend, years and years trying to make back their losses. And just one other thing, I came across some interesting studies on the long-run economic consequences of pandemics. We were in a deflationary environment for debt weight and demographic reasons before we had COVID-19 come. But there's been some researchers at the Federal Reserve Bank of San Francisco released a paper in March, where they looked at the last 15 pandemics in the world where the death toll was at least 100,000. And what they found is that all of them had sort of an interesting common outcome or impact, which lasted for decades afterwards. And this was that they were followed by periods of low interest rates and depressed investment returns, but skewing higher wages over time. So I think, we already had these deflationary aspects in the world. We already had very grim investment prospects because there was too much capital floating around chasing too few really fundamentally good ideas in the old business technology that we were looking at. And in this environment, that's why it's not a good time to be trying to buy and hold these generic sector indexes and ETFs and funds and portfolios that people have been doing for the last 20 years in fits and starts, sort of buying high, selling low, buying high, selling low, like just a disaster to try and get some dividend income. Well, the aftermath of this period suggests that if you don't time this cycle right, you're going to be paying for it for the next many years after this. So it's very important to keep your liquidity, to try and avoid the losses, give it some time to play out, and then have a strategy to look for what's the proper asset allocation for you after things have sold off significantly.
We'll have more with Danielle Park right after the break.
Cyprus Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cyprus Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cyprusdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, are companies using government aid to still buy back their shares?
No. So, I suppose potentially there's been the small business loan program in the United States, which has gone to a lot of public companies have actually tapped those loans, which is not how how people thought of the program. I don't know if it's how the legislators envisioned the program happening, but it's not how, the average, person hearing about, a small business assistance program, great. You don't think of it going to companies that can also access the capital markets to raise, either by selling shares or selling their bonds and getting money from investors. You would think it would go to more non-tradable, non-public companies who don't have access to other funding. So there has been some of the larger companies certainly taking the cash. And to the extent that they use it for payroll and paying their rent and utilities, it's supposed to be forgivable, that portion of it. But so I don't have any evidence that they've been using it for buybacks per se, but I suppose that in some cases that would be part of the liquidity. Buybacks in general have fallen off significantly, and that's very typical. They say the public buys the most at the top, at the least at the bottoms of market cycles. The same is true for corporations. They tend to buy the most when things are extremely priced and when they're sort of using funny money to merge and acquire other companies, and funny money in the sense of their share prices. But when they get into a downturn, of course, cash is at a premium, and most of the time they haven't squirreled away enough reserves for any adversity that may come along of any duration, and that's what they're facing right now. And of course, the number of companies that are filing for bankruptcy is the largest wave that we've seen in many years. That was already, if you recall, building in Canada on the household sector. Certainly people that didn't own real estate, renters, were filing for bankruptcy over the past couple of years, and it was increasing significantly every month. And the trustees and bankruptcies have been reporting on this steady flow, but year to date they're reporting that they see a big jump in homeowners who are now getting into trouble filing for insolvency protection. So all this thing, but the one article the one point I was talking about is that technically speaking, if a company is filing for bankruptcy and they have used a bunch of cash in the past, several months to do things like buy back shares to goose their share prices and to advantage the executives who may have sold personal holdings into the same flow of the companies buying it. That sort of thing could be deemed, a breach of their fiduciary duty to shareholders and creditors and the employee pension plans. It could be also seen as a fraudulent transfer, under the bankruptcy law. And there is case law to show that it can actually be clawed back. So if you think about the Ponzi schemes that have gone on, the Madoff saga and whatnot, a lot of people were withdrawing 15% a year as an example. The investors of that pool were taking out 15% a year, which was all fake. It turned out that he wasn't generating that. It was just coming out of the new money coming in. Well, in the bankruptcy proceeding, of course, they went back to those investors and said, you have to give us back the money you took out because it wasn't actually lawfully gained. It was illegal proceeds. And so the trustees in bankruptcy clawed money back from people who had made withdrawals from this Ponzi scheme. So the same kind of logic goes for, in some cases where companies are now filing for bankruptcy because they didn't retain enough liquidity to get through even a month of income disruption. They could arguably be, the trustees could arguably go after the dividend recipients and the shareholder recipients who got the benefit of these buybacks in the last few years. So it's a complex area, and it's not by any means easy to prove, but it is an avenue that there is case law to support that these things can be examined. And I think that because we're going into this unprecedented period of financial distress, unprecedented in our lifetime at least, since the 1930s, that all bets are off. I think that the pools of money, there's been so many IOUs left in the drawer. We've talked about this in the past with pension plans, how there's just not enough money to fund all the promises. And companies did not prepare, and they've been bonusing executives even in 2020. Even as they're filing for bankruptcy, they're bonusing executives. It's mind-boggling, the runaway nature of the corporate sector. And so I think that, if this lasts many years, like this whole, financial losses coming through the system and, writing down bad debts and pension plans having to be restructured so people don't get to take out what they were promised. And if this is the era we're going into, history tells us those periods are repeating and common through centuries. And that in that time, what you think is not possible, like you think, oh, they'd never do that. They'd never try and claw back money from shareholders. You'd be surprised how that's exactly what happens, right? So the unthinkable becomes the common when when there's so much stress in the system. So I think we just have to keep our eyes and ears and minds open, that just because we haven't seen something in the past couple of decades doesn't mean that we're not going to see it now. And I find a great help in reading, other periods like Capital and Ideology. Thomas Piketty's new book looks at centuries of financial cycles and events and power shifts from extreme, wealth concentration and how that gets resolved over time, how pendulums swing. And it is quite fascinating to contemplate all the many ways in which behaviors are changing today and how long-lasting that shift may prove to be.
Danielle, is there an upside when it comes to our health from the pandemic? We can't go to pubs and restaurants?
Well, sure. I mean, I like to cook, so I'm someone who enjoys making food at home even before this. But generally speaking, I think part of the the disease that has plagued us, as I call it, is people have spent too much on, have abdicated too many personal jobs, hired too many people for doing all these things for them, and they've got the debt and low savings to show for it, right? So one of the great wastes has been people not buying fresh food and preparing it with their family and teaching their children how to cook, but, buying prepared everything, frozen stuff, throwing it in the microwave, picking up drive-through, and it's very expensive in a lot of different ways. It's very expensive in terms of their finances, which is part of what's gone wrong with the whole balance sheet of a household. It's also bad for health. Let's face it, it tends to be much more, full of emptier calories, damaging in terms of extra weight and hypertension. There's a study I saw where only 12% of the North American population was assessed as having a normal metabolic state, a healthy metabolic state. So not just being overweight, of course, we're talking about all sorts of, disorders of the vascular system and also of diabetes and things like that. So a lot of this, almost all of it, 80% or more, is diet related, right? So if we could, and not only that, there's of course all of the superfluous packaging and garbage that comes off of when you're constantly taking food out, and most of that has been in plastic and things that will never break down. So there's really those, the pollution, the poor health, and the waste of finances for the household that is manifested in all this debt. That's all connected. So it's great to see that there's been some really cool studies done over the past couple of months all over the world, looking at the reality that more people are now first of all, because they have more time, but they have an interest in trying to figure out how to make food again, and they're teaching their children again, and they're buying local more, and they're, reporting losses of weight and saving money. And I think that all that can be very positive, and that, there's different studies from different places to suggest over 3 or 6 weeks a behavior shift can actually become a long-lasting habit. So it'll be very interesting to see, if this period goes on for a while longer, and I think it will, it arguably could be a long-lasting behavioral shift again, and I think that could be very positive.
Well, in Belgium, they're pleading for people to eat 2 plates of French fries a week to look after all the potatoes that are going to waste, but are those the kind of potatoes you want to eat? And by the way, when you said a personal change, yes, by not hitting the pubs and restaurants and also journaling what I eat. I've lost 12 pounds since this started. So
there you go.
There's
a lot of people, they're out walking more, they're not driving as much, and they're just eating, and they're wasting less. That's another thing the studies have shown, is that they're eating their leftovers. And they're not throwing food out as much. So all that's very positive. I mean, a lot of our supply chain has probably been concentrated in the wrong areas, right? So we may be producing too many potatoes for people to buy fast food French fries. And in the new model, maybe people will make more of their own, russet wedges at home, which I love to do. With lots of great spice and some healthy olive oil baked. You can have an alternate, which is way more delicious and not nearly as toxic for you. So it may be that the local producers are going to have more customers for their product, whereas some of the mass industrialized that we're doing wholesale selling to the large corps and the fast food chains, they may find that they have to correct or change their distribution demand systems.
Well, we've seen the biggest COVID outbreaks have been at the Cargill massive meat packing and slaughterhouses, and we haven't seen anything traced back to the ma and pa organic farming, whether it's for meat products or for vegetables.
Yeah, well, the mass industrialized farming that treats animals like a commodity, and it's been a lot of our problem for a long time. So it is interesting that food is becoming front and center here, because food is, of course, the whole interconnection with eating animals and mistreating animals, quite honestly, is how a lot of these viruses make the jump in the first place. So I think, as I said, it's a financial crisis, but it's also a health crisis, and I think people are really connecting the dots and understanding that what they eat, what they do with their spare time, whether they smoke, all these things matter in terms of our ability to, cope with physical threats, including viruses. And so hopefully, there's lots of room for us to make some great change here, and it seems like we're kind of on the right track there. So I'm optimistic.
Danielle, thank you so much for chatting with us.
Hey, thanks, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.